U.S. markets rallied nicely today after finding out that the U.S. GDP rose by over 33%, which of course is a spectacular number, but it's important to take context and consideration here with, of course, the prior GDP number being absolutely horrible because of what's been going on with the coronavirus. So anyway, at least it was an excuse for one day to get the stock market rallying to the upside. So we'll take a look at all of that, see what it means for not only stocks, but maybe bonds and interest rates and commodities as well. And then we'll take a look at a trade application example where I do focus on kind of the bond and interest rate relationship for an options related trade. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 29th, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe. While you're there, check out our description area and sign up for our email distribution list. We're also heavy users of Twitter. Feel free to follow me if you're not doing so already. My handle is @BrandonVanZ, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we have a presence on Facebook as well. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's action. And as you can see, I've got chart 6D pulled up here initially. As a reminder, I tend to start with this particular chart whenever we have a move of over 1% in either direction for the S&P 500. And today was one of those days. We were up 1.19% when it was all said and done. Now, keep in mind, this could very well end up being some sort of a dead cat bounce type of a situation where, of course, yesterday we had this red bar all the way down here past this fuchsia color telling us that we had a 3% negative move yesterday. So while it's nice to see this green bar up and through the blue line on the upper portion, meaning that we had a 1% up move today, we're just basically getting back a little bit of what we lost yesterday. So I don't think it was a robust move by any stretch of the imagination, and therefore we still have a lot of work to do if you want to be bullish going into the election here in the coming week. So nice to see that we kind of stopped the bleeding a little bit, but I for one am not going to make too much out of this. Now keep in mind that the VIX is still at a fairly elevated level. Notice this purple line down below here. This is basically the pathway of the VIX. Right now it's at 38. We were above 40 at one point in the morning session, but as stocks rose a little bit, the VIX fell a little bit. But keep in mind, 38 is still considered quite high, right? 38, if we were to kind of use my cursor here and use the crosshairs, we can see that this would take us effectively back here to the first week or two of June as far as how high we are on the VIX right now. And of course, we experienced a much higher VIX during the worst part of the coronavirus back in March when we actually breached 80 at that time. So we're half of that level, yet where we're at right now is still considered above average compared to normal historical volatility. So we'll see where that takes us. But right now, naturally, there's a lot of nerves in the system. Remember, a lot of people call the VIX the fear gauge. That makes a lot of sense considering there's people that are fearful as to what happens to the stock market, with the upcoming election and, what happens if we don't have an answer on Tuesday night as to who is going to be in the White House next year. What if this drags on for weeks, if not months, before we figure out who actually won the election? And that's a lot of times what the market fears the most is uncertainty. So we'll just have to take it day by day. But for one day, we did have at least something to celebrate here with the markets up over 1%. Let's take a look at the visualize area of the Market Watch tab and see how the S&P 500 did on a breadth perspective. And you can see we actually had some pretty good breadth today. We had 355 issues higher within the S&P 500 and only 146 lower. So all in all, not too shabby. We had, strangely, a little bit of a kind of a reopening type of a day. If you want to think in broad themes there, you generally have your coronavirus stocks where you're kind of locked down as an economy, and then you have your economic reopening plays. Today was one of those economic reopening plays. We actually saw a number of the coronavirus plays, your Zoom videos and your Pelotons, struggling today, whereas you saw other areas like some of the oil stocks, for instance, that were rallying here today. So we'll see where that takes us. But again, a little bit of a dead cat bounce here is the way it appears at first blush. Let's get back on track now with kind of our normal chart routine. And I'll start with chart 4B here. For those of you that are premium members following along at home, remember you have access to all 50 plus of those premium charts that we give all of our premium subscribers over at Market Scholars. So this chart 4B here will basically be a high-level overview of the 4 major U.S. equity indices, and it gives us a sense of whether everything's kind of traveling in the same direction or if there's little differences here and there. And right now there is a little difference. I'm not going to make too much of it, but I will point out that the two charts on the top, which are the S&P 500 and the Dow Jones Industrial Average, they both have what we consider to be a strongly bearish posture right now. Notice the color change on the background of the chart. It went from light pink to dark pink on the S&P 500 as of today, because that green line on the market forecast technical indicator is falling and is now below 50. So you can see it's been falling for the last couple of weeks, but today was the day when we took a sharp enough dive on that green line where we're now below that indicator's midpoint. And the same thing is true over here on the Dow Jones Industrial Average, with the only difference being that actually took place yesterday. Yesterday we went from that light pink to dark pink, and we continue to be in that territory here today as its green line is at 34 and falling at this moment in time. So that makes those two charts kind of the laggards of this very moment in time, whereas the two charts on the bottom you could consider a little bit stronger. Now, again, don't make too much out of that. They're all considered weak to one degree or another, but these ones on the bottom are a little bit stronger than the ones on the top. And the reason we can say that is the background colors of those two charts are still that light pink color. We have not shifted to a strongly bearish posture yet. We would consider this to be a weakly bearish posture. So in other words, slightly stronger than the charts up at the top. And that seems to make sense to my eye as well. Remember, there's hundreds of technical indicators out there. The market forecast is just one of them. So you could build a case, bearish or bullish, with a whole bunch of different technical indicators and push your agenda however you want it. We have no agenda here. We're just here trying to read one particular indicator, also recognizing that one particular indicator is never going to be perfect in its analysis. But right now, I think it seems to make sense to me that the posture using the market forecast suggests that those top two charts are more bearish than the bottom two, because you'll notice the placement of where the price action is versus something that you can pin it to, like that 30-day moving average. Notice we have a lot more separation between today's price and the 30-day moving average on the S&P 500, and today's price and the 30-day moving average on the Dow Jones Industrial Average. Now, if you look at the placement of the candles versus the 30-day moving average on the other two charts on the bottom, notice how close they are. In fact, they're both at just a stone's throw away from the moving average, and actually touched it at one point during the session here today. So again, you're hugging that moving average a little bit more firmly there with those bottom two charts, telling us that the bulls haven't completely rolled over, and the bears have a bit more work to do to convince market participants that there should be bearishness in the NASDAQ and in the Russell 2000. That's pretty much all I had for you there on this particular chart. Let's go ahead and advance to our next chart now. And we'll take a look at the 3 green arrows chart. This is 4D, for those of you following along at home. At this moment in time, we actually have 3 red arrow signals across the board. Notice the background colors of this chart setup are all pink at this moment in time. And what that identifies here on chart 4D is that with the 3 different technical indicators that constitute the 3 green arrow system, they're all considered bearish right now. Those indicators are, in the case up here on the S&P 500, we have a red arrow on the 30-day moving average, meaning price is below that moving average. We have a red arrow here on the MACD histogram telling us that its current reading is below the 0 line, telling us that the stock market has lost momentum. And then we also have a red arrow here on the stochastics, which gives us a general idea of whether the stocks or in this case, the stock market is trading close to the highs of various ranges or close to the lows of various ranges. So when we have a red arrow here, it's telling us that we're more apt to be closing near the lows of previous price ranges. So all of those things combined give us our 3 red arrows signal. Now, as I was mentioning on Tuesday when I did this presentation, it doesn't necessarily mean that we have a bearish trend on our hands. It just means that now is not an ideal time to be a bullish trend trader until we start seeing a little bit more stability in the charts. As I look at these charts right now, I don't see a significant uptrend or a significant downtrend. I see a market that is chopping and slopping sideways, and for a lot of folks, that was to be expected as we head into one of these unknown events like the election. Until we get clarity there, the market's probably going to have a hard time gaining traction in either direction. So as it stands right now, we do have 3 red arrows on all 4 of our charts. Let's take a look at our 1040 crossover method now, and this will be chart 4C. And as you can see here, we do have bullish crossovers across the board here. Keep in mind that on chart 4C, these charts are 3 years in length, and each one of the candles is 1 week in length. So it's a little bit of a further look back period than what we had been looking at here just a moment ago with the other charts. This gives us maybe a broader perspective as to not just what's happening right now, but what has happened over a longer period of time. And remember that these particular signals where we're looking for a crossover of the moving averages themselves, they don't happen all that often. So as an example, in 3 years, we've only had a couple of crossover changes that have taken place. We've mostly been bullish, for instance, here on the NASDAQ, with a brief period of bearishness with that crossover there, and then we had another one right here in 2020 during the coronavirus time period. So basically in 3 years, we had 2 very brief periods that would have been considered bearish. Otherwise, this has been a very strongly bullish chart. And so some folks might use this with, let's say, their 401ks or something along those lines where they don't have the opportunity to be as active with their trades as the rest of us in our brokerage accounts, and maybe they just want something that is providing some sort of a signal every so often, maybe once a quarter or, a couple times a year or what have you, and this would maybe fit the bill a little bit better in that case. But right now, the orange line is above the blue line in all 4 of our charts, telling us that the 10-week moving average is stronger than the 40-week moving average and therefore considered more bullish in the shorter term. All right, let's go ahead and now pop on over here to our 12 grid analysis, starting with chart 5A, and this will be our asset class 12 grid. So as we get started here, because we're going to be talking about asset classes, it does bring up something I wanted to mention. Give me just a second to pull it up here on the web. I taught a question and answer session class today, so that's kind of one of those classes for our premium members where they get a chance to ask David and I direct questions. The other classes that we teach throughout the week are called trading rooms, where we as the instructors are driving the agenda, prepping for trades and commentary and things like that in advance. And then we each offer a question and answer session each week as well. I hold mine on Thursday mornings and David holds his on Saturday mornings, where we are not in control of what gets discussed. Instead, we let our premium members make that decision, and so they ask us questions along the way. So we did get the recording posted already, so I'm thankful that that WebEx is getting our recordings back to us a lot faster this week, I've noticed. So it's already posted to the calendar for those of you that missed the class today. Some of the questions I was asked is about Match Group, so Tinder and Match and all of those dating websites, whether that would be a good top-down trend trading candidate. Also discussed IFF, International Fragrances and Flavors, as a dividend growth investing candidate. We talked about Tiffany and its takeover by LVMH. We also talked about this one right here. This is the reason I came over here just now. Dean had asked me what are my thoughts on TLT, because he's been kind of hearing me talk about it quite a bit here in these market outlook videos lately. So remember, if you're a premium member of Market Scholars and you have a question on something that David and I said even during these market outlook videos on YouTube, you're more than welcome to ask us about that in our Q&A formats. Remember, you can go up to the top of our website and hover your mouse over the Trading Rooms tab and come on over here to, in this case, question and answer session for Brandon Van Zee, and then you would just basically reply to that open thread with whatever your question might be. So we talked about TLT there, and then we talked about Coresight Realty as a potential dividend growth investing candidate. We also talked about how to try to glean as to whether a dividend cut is on the horizon, and then also looked at MPW, a healthcare REIT, as a dividend growth investing candidate. So lots of good stuff there as always. Also, while I'm over here on the internet, I do always like to say thank you and share my appreciation with you for those of you that click like for me on Twitter. I always try to get to triple digits if I can help it. As long as we're at triple digits, then I have no issue putting the time and effort into producing these free YouTube videos, as if you guys can help us along by sharing this information on social media. So to the 109 of you that clicked like for me on the video on Tuesday, thank you very much for doing that. Please keep that up. And that way it gives us motivation, David and I motivation, to keep on doing these free videos for you in the future. Of course, our priority is for our premium members who pay us money to be part of our classroom experiences. These free YouTube videos are just extras. So if you want to encourage us to continue to produce them, the one thing that we ask of you is just simply to click like for us there on Twitter. You can do it while you're watching the video right here on our website. You can also just go over to Twitter, and it's usually pinned to the top of our timeline. And there's a couple other places, like in our email that we send you in the notifications. You can do it from there as well. So there's a bunch of places that you could do it. Anyway, thank you for doing that. Really appreciate that. And then tomorrow, David's got his very popular technical analysis trading room that he always teaches at 1 p.m. Eastern time. So make sure you're tuning in for that excellent class as well if you're a premium member. All right, back on track here now with some of these charts, including TLT. I'm going to get into a trade application on TLT here at the end of the video here today. But right now, what I'll point out is that this is performing the way that I would have expected. So I've been mentioning to you guys here in these videos in recent Tuesdays and Thursdays that my set of assumptions for bonds right now is that if you want to preserve your capital in bonds, to me, it seems to be that foreign bonds is the place where you would do it. That's where you're seeing a little bit more strength. That's one of the things I discussed in my answer to Dean earlier today. And so if you're looking for stability within the bond market, it does look like foreign bonds are able to give that to you a little bit better than what we're seeing in the United States. I also talked about in that answer how high yield bonds tend to follow the price of oil a bit more. So you'll notice that the foreign bond market looks fairly strong right now. And then the chart over here, high yield bonds, you see a broken support level, you see a pink background color, a red moving average. All those things tend to be a little bit more bearish. And part of the reason behind that is a lot of the junk bonds these days are issued by struggling small and mid-cap oil drilling companies. And you can see down below here, oil got smashed today. We hit multi-month lows on oil. We were down nearly 3% there. And so naturally, if oil prices continue to torpedo lower, there's a greater likelihood that there will be bankruptcies in the oil patch. And if there are, then they might not be able to pay back the money they borrowed, which puts those high yield bonds under a little bit of stress there as well. So that's one thing that you can be aware of in this current environment. Remember, every decade kind of brings us a different group of stocks that are struggling for a variety of reasons. Some of you might recall like the savings and loan scandals of the 80s and 90s. And of course, you know, we saw a lot of the dot-com blow-up companies back in the year 2000. So, you know, we have these moments in time where there are companies on the brink that need to generate capital one way or another. And if they can't find capital acceptable rates elsewhere, then they have to raise money through the junk bond market. So right now, if you're somebody that's betting on junk bonds, you're kind of crossing your fingers that oil prices stabilize. But back over here to TLT now. Interesting thing about TLT is that the background color of the chart is light green. You can see that the intermediate line on the market forecast is at 32 and rising. So technically there is a weekly bullish posture. Notice the dark green color of foreign bonds. That's a strongly bullish posture. So that looks like a much more firm chart to me right there. We consistently are bouncing up and off of a rising moving average. With TLT, we are consistently bouncing down and away from a falling moving average. So of the two, it strikes me as foreign bonds doing a little bit better, U.S. government bonds a bit weaker. Now you'll also recall on Tuesday when I was talking about, hey, if you just for a second forgot that this chart in the lower right-hand corner said TNX and it said, you know, some other company's name in there or another growth stock or something like that, you would look at this chart and you'd be salivating because this particular chart is really bouncing nicely up and off of that moving average over the last 3 months. It's a very consistent uptrend, higher highs and higher lows along the way. Remember, when interest rates go up, bond prices go down, all else being equal. So right now, I'm kind of in the mindset that while the background colors are light green and light pink for these two, I'm really not paying attention to that right now. Instead, I am expecting that the trends themselves hold. In other words, the trend of higher interest rates continues into the future until it doesn't, and the trend of falling U.S. government bond prices also holds into the future. You will notice that the U.S. dollar was up today. It was up a little bit more earlier in the session. We kind of discussed that in my question and answer session today as well, talking about how a lot of times you will find that when the TNX rises, you will find the US dollar being a little bit stronger, as there's always that trade-off that takes place across the globe. If interest rates in the United States are a little bit higher, and that's what this TNX is telling us here, is that they have been heading higher for the last 3 months, then there's oftentimes comes with a little bit more strength in the dollar as well. Now, that can cause reverberations, especially in the foreign stock markets and in the commodity markets. And we've talked a lot about gold, at least I have. I can't speak for David. I'm sure he has as well. I don't get a chance to listen to all of his presentations, but I know I've been talking about gold a lot in the last few months. And where I've been with my mindset in the last couple of months is that I'm bearish on gold until I have a reason not to be. And I've always stated that I don't feel good about doing that because I've considered myself somewhat of a gold bug longer term, and I still think that way. I still think gold will head higher over the longer term, but that's not what we're talking about here in this video. This video is kind of geared towards more active shorter term trading, and right now I think gold is weak. It's bearish, which is why we have a bear call spread going on a gold mining company right now as part of our trade application example. So I don't think that this behavior out of gold in recent sessions has done anything but embolden my opinion that gold is weak right now. You had a chance here for one day right there on October 21st where it looked like gold was maybe going to get it going to the upside again. It spent one day above that moving average and then it failed the exact next day. That does not give you the warm and fuzzies if you want to be long gold. Right now, it looks like we're bouncing down and away from that falling moving average, and we have that dark pink background color telling us that we have a strongly bearish posture on gold right now, according to the market forecast technical indicator. Same thing with oil, as I mentioned before. The other thing that I wanted to point out is something I also addressed on Tuesday, but just to reiterate that it's gotten even worse since Tuesday, which is the difference between the developed markets versus the emerging markets on a foreign basis. So this is everything outside of the United States that I'm discussing here. EFA looks absolutely horrendous. Remember, we looked at those charts on Tuesday when we looked at like Germany was falling apart, France was falling apart, Italy was falling apart, the UK was not looking good. Those are all some of those countries that are part of EFA as the developed countries around the world. the developing companies, or countries, I should say, or some people might refer to them as emerging markets, China and India, remember we talked about that on Tuesday as well, are doing quite well. And as I looked through a lot of charts here today, some of you saw me tweeting about BYD, the big electric vehicle manufacturer in China that Warren Buffett and Charlie Munger own. I was saying on Twitter that they must have a smile on their face because that stock has absolutely rocketed it. It was up another 9% today, and a lot of those kind of high-tech oriented Chinese companies have been doing well. I mentioned Alibaba and Baidu on Tuesday as well. So that's an area, a specific niche around the globe that seems to be working right now. High tech in China is one of the stronger themes I've seen out there. And so just pay attention to that relationship because this is fairly atypical. You usually don't see the separation between developed markets and foreign emerging markets quite to this degree. A lot of times they're trending approximately in the same direction. Right now, we have a complete night and day situation. The emerging markets have a strongly bullish posture, and the developed markets have a strongly bearish posture. And a lot of that just comes back to how are these various nations doing with the coronavirus? You know, a lot of the fear in Europe right now is that there's another lockdown on hand because of the coronavirus, and so that's part of the reason why Germany stock market is not doing well, as just one example. Whereas China has kind of gone through the coronavirus quite some time ago, so they might already be on the outside of that difficult period and getting kind of back to a more normal economy again. Let's take a look at what's going on with sectors here. And so from a sector perspective, that is going to be chart 5C. You can see that it doesn't look too bright here in the United States. We actually only have one chart that is green at this moment in time. That's utilities, and strangely enough, utilities, we're not necessarily lighting the world on fire today. It's just that they've been able to kind of preserve their value a little bit better in the most recent market swoon. So utilities are the only one on the board that we would consider to be strongly bullish at this moment in time. All of the other charts here are either strongly bearish in most cases or at least weakly bearish. The communications sector actually had a very good day. You can see communications was up 2.5% today from a sector perspective. So that might be part of the reason why the background color there is only light pink as opposed to dark pink. You don't have quite as much bearishness there. And part of the reason was, what we saw out of Pinterest here today. Pinterest was rallying strongly today. It was up 26%. And I was mentioning that here to you guys a week or so ago, how don't fall asleep on Pinterest. I know it's not the most exciting social media property out there, but it has been absolutely spectacular in terms of its trend. And today was a very aggressive move higher there for Pinterest, which helps support those other communication stocks on the whole. Again, up 2.5% is a very strong day there. You did also see energy with a 3% rally there, but I think that's kind of a slightly different situation. Of course, energy hit a multi-month low this morning, only to rally back 3% and get back part of what it lost there, yesterday, and is still below that falling moving average. Notice that communications rallied back up enough where we're back above its moving average right now, so a little bit stronger there in communications. We also saw some pretty big moves there out of materials. That was up over 2% here today, and we also saw technology up 1.6%, along with industrials up 1.46%. As far as those that were down today, I only have a couple of examples there. Only healthcare and staples were down, and staples just barely. It was only down 2 pennies, so you could really call that just flat. Healthcare actually had a legitimately bad day. It was down 0.82%. So that's an area that has really struggled as we kind of go forward into the elections. Maybe a little bit of fear out there with a potential blue wave on the horizon as to what Democrats might or might not do if they control D.C. and what laws might be enacted and what that could mean for healthcare companies. So we'll see. But right now, healthcare looking pretty ugly. All right, let's get into our trade application example now. And for that, I'm just going to pull up, let's do our swing trading chart here, 3A. And I'm going to pull up TLT. And as always, I've already placed this trade. The trade was placed about a half an hour before the market closed today. So for those of you that are premium members of Market Scholars, one of the additional perks that you get is if you've downloaded the Telegram app and have signed up for our channel, you would have received the details on this already. It gives you maybe an information edge over everybody else who's just watching the free YouTube video later at night. So that way you can consider the trades for yourself prior to the next opening the following day. Anyway, the trade that I chose to do was on TLT, and it was a bearish trade. No surprise there, considering my commentary around this chart in recent weeks and months. But what I see here is a downtrending security. I see one that has struggled on multiple occasions to get up and over the 30-day moving average. You saw a little bit more stability right here in kind of late September, but even there, you only were able to stay above the moving average for maybe a week or so before giving up the ghost yet again. So this strikes me as a legitimate trend that's in place right now, where we see lower highs and lower lows very clearly. And today is one of those bounce days, in this case a kind of like a swing trading mindset here, where you had an oversold cluster signal. So I pointed that out to you guys here last week. And I said, don't be surprised if you have some sort of a reversion to the mean type of a move. Well, we got it. We got 4 days in a row of upside on TLT. The question is, where did it stop and how would it handle that area? Well, it stopped right here just shy of that falling moving average, which looked awfully similar to what happened back here the last time it went up to the moving average. In other words, it got enough oomph to get up there, but then it reminded itself that it was in a downtrend and it shot back down lower. So that's the bet that I'm placing here. I sold a bear call spread. It was a December spread, monthlies, and I did the 165. 167, so a $2 wide bear call spread there. If you need the details on the fill prices and all that, you can check your Telegram if you're a premium member. But the general idea of that trade is it makes money off of time decay. It does have defined risk, so I know what my worst case scenario is, just in case I'm flat out wrong with this call and bonds just rocket higher. Remember, that is a possibility. If something goes chaotic with the stock market, it is possible we have a mass entry into government bonds. But if that doesn't happen, then in this case, I make money off of time decay. So even if this thing goes sideways, I'm going to win that trade. Even if it goes up a little bit, as long as it doesn't go above 165 on expiration day, I'm still going to win that trade. And then, of course, if it ends up going down and forming a lower low, which appears to be a fairly strong likelihood, then in that case, I'm going to make money as well. So anyway, that's our trade application example here today, based on a continuation of the downtrend in TLT after we're bouncing down and away from that falling moving average and producing that newly minted bearish near-term posture right there on the market forecast. So that's what I had for you here today. David should be back with you tomorrow. Remember, he's also teaching his technical analysis trading room for those of you that are premium members. If you got value out of tonight's video, the one thing I ask out of you is just to go over to Twitter and click like for me there if you want me to continue to do these videos going forward as always. So thank you very much. I want to wish you all the best of success with your trades and your investments. Goodbye for now.